Hi there traders and investors, I'm glad to present to you a red hot market review prepared by analytics and forecasters FxCo portal. Here we go. Today is the 7th of December and Mark Bektovich is describing why gold needs to rise to $3,000 an ounce. Gold jumped almost 200 an ounce from the levels of November lows, and in anticipation of important statistics on US inflation and the Fed meeting, buyers decided to fix part of the profits. This led to a natural pullback. TD Securities said a noticeable consolidation is required before the trend followers in the precious metal trade return to the market and provoke further price hikes. The transition of gold to trading in range will give time to assess the situation. Gold fans are counting on updating historical highs, and opponents are calling for caution. One of the main bulls, Standard Chartered, claims that amid the fall of Bitcoin to $5,000 and the associated overflow of capital from the cryptocurrency market to the precious metal market, the latter will rise to $2,250 an ounce, or approximately 26% from current levels. Saxo Bank mentions the so-called outrageous scenario, according to which the increase in military spending will lead to a new round of inflation, which will get out of control of the central banks. As a result, fiat currencies will depreciate and gold will skyrocket to $3,000 an ounce. Such forecasts are based on market shocks, but if we take into account the traditional drivers, the figures will be much less impressive. ING knows that the precious metal will rise steadily only when the Fed comes to the end of the monetary restriction cycle and inflation slows significantly. As a result, the dollar will suffer the reduction of speculative positions on which became the key trump card of gold bulls in November. Shock scenarios attract attention, but traders should focus on the real stuff. First and foremost, the Fed's monetary policy, the dynamics of the dollar, and Treasury bond yields. Yes, the Fed intends to raise the federal funds rate by 50 basis points in December rather than 75 basis points. But after peaking at 5.25%, the cost of borrowing could be there for a very long time. In this regard, it's too early to bury the US dollar. If it rises from the ashes, gold is in trouble. Technically, after it reached the target of 88% Fibonacci of the bad pattern, risk of a pullback towards 23 Fibonacci, 38 Fibonacci, and 50 Fibonacci of the last rising wave increased. For now, it makes sense to try to win back the inside bar by selling gold from 1767 and buying it from 1777 level. Let's have a look on euro-dollar pair with Jakub Novak. Euro rose on Tuesday because of rumors that the ECB is seriously considering how to get rid of the 5 trillion bond balance sheet as quickly as possible. However, this did not affect the downward correction this is happening in the market. Currently, the gap between German and Italian debt yields is narrowing, which could prompt politicians to announce the start of quantitative easing as early as next week. This is the challenge that the ECB is facing, as they are expected to present a strategy to reduce the balance sheet, as well as an interest rate hike of 50 basis points next week. If that happens, the central bank could focus on getting the inflation shock under control next year. The US Federal Reserve is also hinting with all its might at easing aggression, so investors expect the global cycle of policy tightening to slow down soon. However, it's clear that the ECB has to gauge risks with regard to the uncertain economic outlook, the dynamics of rate hikes, and the need for governments to borrow. The shock to the UK market this year was very instructive, so officials are gradually rolling around the idea of launching QT to minimize investor fears. Another concern is how much more debt will have to be issued by governments. The ECB has warned that excessive support could cause additional rate hikes. Now the euro-dollar pair is on this stage to break out above 1.0530. That will spur the price increase to 1.0560. Meanwhile, a decline below 1.0440 will push the pair to 1.0390 and 1.0330. The next station is pound sterling dollar pair with Lowry Bailey. Yesterday, the pound opened and closed the day under the target level of 1.2200. It means that the price settled under this level, and the target now is the support 1.1933, which is the low of June 14. The signal line of the Marlin oscillator going under the lower limit of its own range. And soon we might see it in a downward trend. It's possible that the market is already experiencing the pressure of the double divergence, azure line. It will form and will be a confirmation of the reversal in the medium-term perspective. On the 4-hour chart, the price has settled under the MACD indicator lane, blue line on graphic. The Marlin oscillator is moving deeper into the bearish territory. We see a downtrend to 1.1933. That's all for today. Have a nice trading day. See you next time.